short term, oversold, due for a bounce? Is that how you see it?
Yes, that's been our view. We were actually a little bit early in that assessment a week or so ago, to be quite honest. But, you know, we're looking at forward multiples on the S&P of about 13.5, 14, trailing multiples a little bit higher than that. In markets like this, it's tough to make a valuation case because markets that are oversold can get more oversold. But I think we're pricing in a pretty bad scenario for 2019, even relative to our more sort of bearish 2019 assessment, because I think credit markets have sort of lost their luster, if you will. Credit took a long time for corporate credit markets to actually react to equity market vol, and now we're seeing the corporate loan market start to take some nicks, and the corporate bond market as well. Spreads on high yield are now closing in on 500. They've pulled back a touch over the past couple days. And in fact, the pullback in high yield spreads is one of the reasons why I think we get a little bit of a rally in equities.
So you're saying short-term rally, but long-term into 2019 bearish?
Yeah, a little more bearish. I mean, I think there are a number of risks out there. I think we've got Europe. I think Europe is an issue. I think we have a repricing of sovereign yields in Europe, mostly around an Italian catalyst. I think U.S. housing has started to weaken. And as I just pointed out, you know, I think the corporate bond market and the corporate loan markets here in the U.S. Are going to have some difficulty. And lastly, I would say if we look at earnings revisions, we've come in from, you know, at the end of October for up 10%. Now we're at about up 7.5%. So we've been talking about peak earnings growth for some time, and now I think we're starting to see that happen.
Jeff, you have any interest in characterizing what we're in right now in terms of, is this just a kind of a bull market reset? Are we truly in kind of a bear market environment where the overshoots happen to the downside? How would you play it?
No, secular bull markets last 14 plus years. We're 9 years into this one. I mean, the 1949 to 66 lasted 17 years. The 1982 to 2000 lasted 18 years. This past 2 weeks is just noise. I mean, I spoke to my friend Tom Heath at the Washington Post yesterday because he said, you're the only person I can get in touch with. All the other people I speak to are on holiday. And it's true, the pros have left for the Hamptons. They've left their second in command and making markets in individual stocks. They're telling their second in command, if the market wants to go up, let it go up. Don't stand up against it. If the market wants to go down, let it go down. Don't stand up against it. So you're getting these wild swings. On top of that, you got tax loss selling. You got mutual fund redemptions. And by the way, yesterday was the last day the hedge funds could liquidate and send money back to their investors that wanted out of the partnership.
Although, Jeff, that may all be true, but this is normally the time of year when the second in command is at the desk and the market just drifts higher and we all fall asleep. So obviously there's some reason that the market feels as if there's cross currents it has to price in right now.
Yeah, I think it has all to do with selling into a vacuum. As I said, you've got tax loss, mutual fund liquidation, and hedge funds sent out letters to investors on November 15th that gives them through December 31st to liquidate their hedge fund and redeem their money from the hedge funds. So I think you were selling into a vacuum. Nobody's around. I don't think you're going to know the real destiny of the market until you get back into mid-January. I still think we're in a secular bull market that has years left to run.
I do know some pros who got called back to the desk in the middle of the week. Come January,
I came back early, by the way, Carl.
I believe you. Are we going to keep most off of in the next 4 weeks trade talks, an end of the shutdown, or trying to read more Fed tea leaves into January 3rd?
Look, I think, you know, and I would respectfully disagree with Jeff. I think the secular bull has likely come to an end, and what we have to look at is we have to look at the credit cycle, and that has a lot to do with what central banks are doing. And we have an unusual situation where both the ECB and the Fed, and I think I mentioned it to Sarah yesterday when I spoke to you guys, are simultaneously pulling back liquidity from global markets, and I think that has a big effect. And so sort of historical cycle analysis is a little bit more different now because the analogies are not quite as durable as they used to be. So I think Fed tea leaves are the most important. Of course, trade is also important. I think the news on trade has actually been completely sort of washed over by the market volatility, but Fed and liquidity are most important.